Yes, friends, namaste to everyone. We are going to talk about the complexities of treasury risk management in FY27 and onwards, because there is a structural shift in the asset liability management of the banks. The ALM mismatches are now undergoing lot of change. The credit growth is 18.6% in the June 2026, and credit growth is 13.3%. So it is a 5% difference between the two, and the CD ratio has gone to 82%. This equation is causing a lot of liquidity risks to the banking system, and banks are increasingly borrowing from call markets and also borrowing from the different sources, CDs and bulk deposits, and banks are also raising infrastructure bonds from the market. The infrastructure bonds which the banks used to raise in earlier times used to be in the range of 15,000 crores to 20,000 crores, which has now gone to 1 trillion, that is 100,000 crores. So that is how the liability management is undergoing change. Now, this change is not a temporary phenomenon. This change in the ALM structure, assets and liability management structure of the banking system, that is the residual maturity of the assets and liabilities, which is now giving lot of gaps in the ALM early time periods, is not going to, like CASA is dropping down, 1 year deposit is coming down because 1 year deposits are going to alternate markets, and below 3 years are also dwindling because the preferences of the new age customers who are millennials and who are Gen Z, and now the next level, Gen Alpha, is going to be our customers. In this given situation, there is a structural shift in the assets and liabilities of the banking system, and banks will have to gear up to meet those challenges where the ALM mismatches will be more rampant and the liquidity risks will be more in the times to come. And this is not a temporary phenomenon, for the reason that the customer base is becoming more and more young. There are a lot of government driven deposit schemes like PPF, then senior citizen scheme, there are other attractive schemes with good interest rates. So these are taking away chunk of the bank deposits. Other part is more and more funds are going into alternate investments of the customer, because if you see the trends, the total deposits of the banking system out of the financialization of the economy, that the financial savings of the economy, if you see the bank deposit share, that used to be 57.9% a decade ago, and it has now dropped down to just 35.2%. That means there is a structural shift in the deposits coming into the banking system when compared to alternate investment channels like mutual funds, because the demat accounts are about 23 crores, and the AUM of mutual funds is around 80 to 82 trillion. That is what is, and it is fast chasing the 100,000 crore mark. That is 100 trillion. It may become in the near 2 to 3 years to come. So that is one. That means the bank deposits are drifting away to equity markets, and this is going to pose a lot of risks to the bank in the coming times. So the reason is very clear. Younger population, their savings habits are changing, their risk appetite is higher, they are tech savvy, they are moving the money very faster from the banking system to alternatives, and they are putting in the equity markets, and these are creating a structural shift. Now, what is the solution for this? Now, solution for this is little suggestions about the solutions, because whenever we talk of the problem, we need to talk about the solutions. So, treasury risk management the knowledge of treasury risk management, which is confined to the ALCO team, ALM team, and the treasury mid office and front office and back office operations, that has to slightly drill down to the large branches, and the branches should be sensitive towards the ALM management. They should be little sensitive. I don't say that they should either discourage any set of deposits or attract with additional incentive to any set of, but they should be little aware of the implications of CASA on the balance sheet of the bank, implications of the short deposits on the balance sheet of the bank, and the 1 year to 3 year deposit, 3 years to 5 year deposits, and various segments. And one more thing the banks can explore is the use of AI tools and machine learning tools to further find out the granular deposit behavior from the various geographies, because we have a pan India ALM now. While the pan India ALM will remain the same, but we can always get some geographical differentiation and discuss it in the ALCO to find out how the different kinds of products and services, and can there be some kind of an interest rate alignment with the different geographies? Because if you see the CD ratio of districts, what I am finding is there is a lot of divergence. Some districts, there are about 800 districts in India, but the entire data of CD ratio of all the districts is not available. Nevertheless, about 130 districts are having CD ratio of more than 100. So there are about 230 or 250 districts which are having CD ratio of less than 50. Now, another strategy which the banks will have to use, we have done a great job by financial inclusion since 2010, because we have been emphasizing on financial inclusion since 2010, when Rangarajan committee came up, and RBI has pursued for a 3 year board approved financial inclusion policy, as a result of which now the financial inclusion index is 70 now, and Findex has put it as 89 as the financial inclusion index. So we have done a great job, and PMJDY and JAM Trinity has brought a lot of awareness about the importance of having a bank account. But 30% of those bank accounts are now dormant, and many are inoperative. And even if wherever there is operations, the potential of operations and the actual operations, there is a lot of gap. So I think banks will have to do a lot of job in further deepening the financial account relationship and the connect with the customers, so that more deposits come into the into the ambit of the banks. And the only thing that can be done is the solution is the customer service. And ALCO, I think in many of the banks, ALCO meets once in a month. While once in a month schedule is good, but maybe that we need to have some kind of a information system which can be gathered at a more frequent time, because now in a digital state of the data management, more frequency of looking at the ALM structure and how it is shifting, and what are the forecasting techniques that we use. So I think AI and ML can be used more exclusively for the purpose of understanding the behavior of the deposits that come into the banking system, and the assets that are created out of that, loan assets and other assets. I think a more granular review of these parameters can be of much use to banks to control. I don't say it is controlling, but to align the assets and liabilities to the desired requirements, and also changing the business model of the banks according to the new way in which the assets and liabilities are entering into the banking system. Because if you see the deposits which are going out of the banking system, they are again coming back to us in the form of bulk deposits. They are, because we are chasing institutional deposits, because the CASA which goes from here, or the term deposits which are going from here, are going to either insurance companies or mutual fund companies and other companies. they are placing in the banking system at a high cost. So these cost equations are changing now. So since this phenomenon is going to be permanent, we need to have solutions which need to be permanent, a more granular information. ALCO management has to be more vibrant. Grassroots level people should be more involved. An inclusive function of monitoring will be able to help the banking system. I think we need to understand the complexities of treasury risk management in the current era, that is 2027 FY, and also in the coming times. And this structural shift is not going to be a temporary phenomenon. It is going to be much deeper in the times to come, and the banking system has to gear up to meet those challenges and complexities while adhering to the regulatory framework uh, prescribed by the Reserve Bank of India. So we'll be talking more about these kind of interesting topics in the times to come. If you have not yet subscribed to this channel, please do subscribe. If you like our work, please like and share with your friends, so that more and more people will be aware of how the new changes are coming up and how to gear up the banking system to meet those challenges. So we will be partnering with you if you make some suggestions about the new topics to be included in this kind of series of knowledge dissemination videos that we are going to come up with in future. So till then, thank you very much for watching, and have a great time.